I recently heard of a trading strategy that someone was using at a hedge fund in the real world, and it sounded too good to be true, so I wanted to see if this would have really worked in hindsight. So what we're going to do today is backtest a trading strategy using Python, but don't be too worried if you don't have too much coding experience, because in this video, all of the code is going to be generated by AI. I'm simply going to guide it in the direction that it needs to go to perform the analysis. I will be using today's video sponsor, Datalore, a collaborative data science platform by JetBrains, to write the code today, and it'll be super easy for us because there is an AI assistant embedded within that software that we can use to help us write the code. Now, a little bit about this strategy. So I heard of this strategy where this guy who works at a hedge fund was basically just at the end of the day looking at the 10 bottom performing stocks and then investing in all 10 and then holding them throughout the course of the next day and then selling all 10 of them at the end of the next day, and then basically taking the proceeds and just buying the 10 biggest losers from that day and then holding them through the next day and over and over and over. So this strategy is really playing on mean reversion. If something goes down really bad today, hopefully tomorrow it'll go back up, and maybe yesterday's reaction was too strong. That is the hypothesis. So now let's dive into it and let's actually code this thing up and see if this strategy might actually work. To get started, we're going to go to Datalore's website to sign up for a free trial so you can follow along with me as I code this thing up. And to get there, you can go into the video description below, and you'll see there is this link that says sign up for Datalore. So I'm going to hold Control on my keyboard, and then I'm going to click this link, which should open in a new tab. And now you're going to see this might change by the time you're looking at this video in the future, but I'm using for individuals and I have this option for free. And personally, I just signed up for my email. You could also sign up with Gmail potentially. Once you finally get logged into your Datalore account, you're going to see a screen like this that just has your private workspace and some getting started tutorial. We're actually going to open a new notebook. So you can look over here on the left side of your screen and hit this plus icon and hit new notebook. And so you can see there's 4 different types of kernels we can choose. In this video, we're going to use Python, and we can just give it a name. Let's say Backtesting, and I'm going to keep it in the Jupyter mode. So let's just create that notebook. When your new notebook opens up, it should look something like this. If you have ever used a Jupyter notebook in Anaconda, it's going to look really similar. So the first thing I'm going to do is not actually going to affect any of the code, but it's going to give us some structure. So I'm just going to go here, click more, and then hit Markdown. So I'm just going to title this section. We'll call it Data Retrieval Process. And I'm actually going to just go ahead and insert the markdown for all of our sections, just to go ahead and give us our structure. You don't need to do this yourself. I've taken the liberty to fill out the rest of the markdown, and if you're unfamiliar with exactly what markdown is, it's just language. So it doesn't affect the code. It's just easier for us to look at the steps that we're going to follow. So basically, we're going to follow all these steps that I've outlined. Throughout this video, we're going to be using AI prompts to get the AI assistant in Datalore to write code on our behalf. Now, if you'd like to make this easier on yourself and download the code and the prompts, well, you can go to the video description once again. You'll see a section that says download free code and AI prompts automatically. So hold Control Shift and click, it'll open in a new tab. And now you'll see the report, and I have a little note here that says to edit a copy of this code, you can sign in and create a personal Datalore account like we did earlier. You can also then click the 3 dots up here and download it for free. So there's these 3 dots, and then you can download the code, and you'll have a Python notebook file here that pops up. And you can do it yourself. And then you'll see that what I've included in this copy of the report is actually the AI prompts that we'll be using at each step all the way throughout the video. Now, with all that YouTube guy yapping out of the way, let's actually just dive in to test this strategy. So I talked briefly at the beginning about how we're going to buy the 10 biggest losers every day, hold them for the next day, and then sell them, use the proceeds to buy the 10 biggest losers from that day. And basically, we're going to hope that if a company or a stock had a bad return one day, it'll gain some of it back the next day because perhaps the previous day was an overreaction. In this video, we're going to be using the Dow Jones Industrial Average. If you're not familiar, these are 30 of the largest stocks in the US picked to represent a variety of different industries. So we're going to be looking at this index every single day. And then we're going to be finding the 10 losing or bottom performers, and then we're going to just buy those ones, hold them for the day, etc. And we're going to compare how does this strategy perform against if we had just bought the index by itself. Will we actually outperform the index? Is this a viable strategy to achieve risk-adjusted returns higher than just buying into the market? So the first thing we're going to need to do is retrieve the data. And so we need to retrieve the constituents of the Dow Jones Industrial Average. That means we need to find which 30 stocks are currently in there. And based on that, we need to find their price data for a certain period of time. And so we're going to fetch the current Dow Jones Industrial Average constituents from Wikipedia, and then we'll save them to a CSV file. And so we can do that using the prompt that I've written over here. So we're going to tell the AI to write code to perform the following. Fetch the current Dow Jones Industrial Average constituents from Wikipedia, save them to a CSV file. Fetch 10 years of daily adjusted close prices for each constituent using Y Finance. So I picked Y Finance as the API to source the data for this video because it is free, so you guys can just use it without paying anything. So, and then we will save the data to a separate CSV, and we'll handle any errors and print the stock symbols that cause the error. Now let's load the constituent symbols and price data from the CSV files into a data frame and handle missing data using forward fill. So basically we just want to find the 30 constituents, get the price history for all of those 30 constituents for 10 years and save it into a nice table, like an Excel table almost, but with Python. So I'm going to grab all this, and then I'm going to go right over into this code cell. And if you ever need to insert a new code cell, you can just make it this blue line highlight by highlighting in between two cells and hit insert code cell, and one will pop up. So right here, you'll see this little swirly icon. This is the Ask AI. So this is where we'll get the AI assistant to write code for us. So it's going to have a pop-up box about this AI here. I think you just scroll all the way to the bottom and hit accept. And then now we will copy and paste our query into there. And then I'm going to hit this little blue arrow, and it's going to start actually writing the code for us. So this is the code that it wrote for me. It might not be exactly the same for you because it's not going to write the same code every time. Let's hit accept and run. One thing we haven't done is imported this Y Finance library. So I'm going to hit accept and run, and it's actually going to fail. That's fine. So we need to import the Y Finance library. So I'm going to go over to here where it says environment. And then in this little search bar, I'm going to type Y Finance. There we go. I'm going to hit install there. Okay. And now it's going to install this package. Once it is installed, it's basically going to ask me to restart the terminal. All right, there we go. Restart kernel. So now once my kernel restarts, which I believe it just did, I am going to now rerun this, and we'll see the output of this code. Okay, so it's actually downloading. I can tell for each one where it says 1 of 1 complete, that means that it actually downloaded the price for one of the 30 stocks. Now let's take a second to analyze the results and confirm the accuracy. Let's just talk through a little bit about what the code actually did. So we told it to go to Wikipedia and grab the constituents of the S&P 500 currently. So it created a variable called URL, and it looked up the Dow Jones Industrial Average page on Wikipedia. So I'm going to click Control-C to copy, and then go up here and Control-V to paste. And then you'll see there's this whole table of the 30 stocks in the Dow Jones right now. And what our code should have done is went and basically grabbed this table. So that's what it's doing. It is reading the URL, and then it's going to store the constituents of that table basically in a variable called Dow Jones constituents. And then it's going to create a CSV, like an Excel file, called Dow Jones Constituents. So let's go see if it did that. So I can go over here where it says attach data, and where it says notebook files. I'll just open this box, and then I see there is a CSV file called Dow Jones Constituents.csv. I'm going to double click that, and here we can see it just popped up over here. Now let's take a look. So we've got in this column here, column 1, all the companies, and then in column 2 we've got the exchanges they trade on. Column 3 has their symbols, etc. So what we'll really actually need is just the symbols from column 3. And then let's keep looking at our code and see what else it did. So now if we go down here, one thing we told it to do is that we said we needed the price data, and that we needed the price data from Y Finance. So let's see how it did that. So now it's going to grab a period of 10 years. So it's trying to find the start date. We told it that we wanted it to fetch 10 years of daily adjusted close prices. So that's why it went and found the start date. It found the date today with this variable, or this command datetime.now, and then it subtracted basically 10 years multiplied by 365 days to find the date 10 years ago. And then for each of those, it went into the Y Finance API and downloaded the symbol. So each of these symbols for that start date. And then it saved everything to a Dow Jones data.csv, which we see here. Now let's open that one. And so let's take a look at that. So basically, we've got this column called date. We also have the adjusted close price here, which is what we're going to be using because adjusted close prices account for dividends and stock splits. And we also have the symbol associated with that. And you can see it just goes day by day. So this is the July 14th, July 15th, July 16th, etc. And these are all for MM, but we should have data for basically all of the constituents, not just MM. So the top of the table is MM, but once that finishes its 10 years, it should go to AXP and all the way down to Walmart at the very bottom. So let's actually test to confirm that we have data from Walmart. So I'm going to just start a new cell real quick, and I'm going to do print. And then within the print statement, it's in this DJ underscore data variable. So I'm going to print that out. There we go. We see that we have a table with the date, and then we do have the adjusted close prices, and then we have the symbol. So we're seeing that we have, at the beginning, it starts with the MMM, and then it goes all the way down for over 74,000 rows, all the way down to Walmart at the very bottom. So from what I can tell so far, I believe that the AI assistant did a great job of generating the code for the data retrieval and the price data retrieval so far. Now let's go ahead and perform the next step of our mean reversion strategy, and let's calculate the daily returns. So we can take the data that we have in this DJ data table and then calculate for each day what was the return for each constituent. So for that, we're going to use our AI prompt that I have written here. So this one, we're going to tell it to write Python code to calculate the daily returns based on the adjusted close prices for each stock in the data frame containing the DJIA prices. So I'm gonna hit Control C, come back over here, and I'm going to ask the AI with this button, put my prompt in there, and I am going to run it, and let's see what code it generates. All right, this code is very simple. Again, yours might not look exactly the same as mine, but basically it's sorting the values by symbol and by date, which I guess to me seemed unnecessary because it was already sorted, but that's fine. Now we're going to calculate the daily returns. And so they're going to be using the symbol and the adjusted close price, which is perfect. And then there's this little Python formula, percentage change, which is just going to take 1 day's price divided by the previous, or subtracted the previous day's price, and then divide by the previous day's price to find the percentage change each day. And then it's going to print out just like 5 rows with this command, this head command. So let's accept and run. And there we go. So we can see just a brief preview of how it's looking. So there should be a new column, yep, daily return, which there's not going to be a daily return for the very first day because it has nothing to go by. One thing we could even do to make our AI prompt a little bit better is in the future is we could account for the fact that there's no daily return on the first row, but it might do that itself. So we've got the first day it had a 1% loss, the next day it lost about a 0.5%, etc. Now let's perform the next step, which is to identify the biggest losers. So for each day we want to find which of the 10 stocks had the worst performance on that day. And to do that, we can go grab this AI prompt, which says, write Python code to identify the 10 stocks with the lowest returns for each trading day in the data frame containing daily returns. I also added this, which is to say, skip the very first day because that contains only NaN values. So I'm going to hit Ask AI. I'll paste my prompt in here, and then I will run that. So the AI accomplished this with actually quite a low amount of lines of code. So it's just going to create this data frame for us called lowest daily returns. And then it's going to show us the first 20 rows. So we can basically just check how it did on the first 2 days, because there's 10 stocks per day, I would assume, but I guess we'll see. And okay, let's take a look. So the first 10 rows are all for July 15th. And it's going to pick, I would assume, the stock that had the 10 lowest daily returns. And I believe that for July 15th, that would be these 10 listed right here. Now, if we scroll down to the next 20 rows, it should go to July 16th. Yep. So we're seeing right starting at this row is July 16th, and it's showing that these stocks had the lowest returns. One thing that I want to clarify about this analysis that isn't going to be, that is a assumption that is not going to be entirely accurate, but there's one I don't really know how to work around, is that the Dow Jones Industrial Average might have had different stocks in it at this time, right? This is 10 years ago, so there might have been 30 different stocks then, or some that were different than the ones that are currently in it. But I just don't have a data set that tells me on every single day which stocks were in it. So we're making the assumption that it hasn't, the constituents haven't really changed. But I think we still should get a pretty good feel for this overall strategy and how it might perform. So this is where we're actually going to simulate the trades, and this is where the AI prompting is going to get a lot more complicated. And this is also an area where I think the human brain still has a lot of value, because you have to know how to come up with the right prompt, at least at this time. And so I'll show you the prompt that I came up with for this one. So basically what we're assuming is that you're going to start with $100,000, and then you're going to equally invest in the losers every day. So I wrote this prompt out, and you're going to see it's quite more complicated than the prompts that we've been working with. And so your results may vary when you use a prompt of this complexity. So I say code a trading simulation using the data frame holding the lowest daily returning stocks. Ensure dates are in date time format using PD PD.to date time. For each date, select the 10 worst performers. So we're picking the losers. Calculate next day's price using merge with the original data, not shift. So we basically, because our data frame that has the lowest daily returning stocks, it only has the 10 losers of each day. So to look at how did one stock do from one day to the next, you could only see the comparison or the returns from one day to the next if it was a loser 2 days in a row. So you actually have to merge with the original data so that you can get all the prices for all the stocks. We're going to start with 100K and equally invest among all 10 stocks. And then we're going to buy at 1 day's adjusted close price, sell at the next day's adjusted close, update capital daily. And what we really want is a data frame with 2 columns, date and capital. So when we have that data frame, that's when we can start performing our analysis to see how did our money actually grow over time, and did we outperform the market on a risk-adjusted basis. Okay, so skip trades if insufficient, capital or missing price data, handle end of data set carefully, and then we want to see what was our final money, our capital at the end, and our total return. I also said to implement robust error checking and ensure that capital isn't depleted or inflated. So a lot of this stuff is just to make sure that there's no errors that occur in the first place. So let's put this in there, and let's ask the AI to run it. And there we go. Oh. Got to add a C. Okay, so here is our code output. So first it's going to ensure that the dates are in the date time format. Then it's going to initialize the capital and results. So basically the initial capital is the 100K as I mentioned. And then the result is basically going to be the data frame that we will use later on to analyze the performance, right? So we have our two columns, date and capital. And how we'll be able to tell how this portfolio actually performed is by looking at the capital each date. Okay, so we will sort data by date. And then let's see, it's getting all the unique dates, because if you think about our data frames before, there was one date for each stock. So we only really need each unique date. And then now we're going to look at the 10 worst performers for each date. And we're basically going to loop through every single date in the unique dates data frame. So we're going to go every day for the entire 10-year period, grab the worst performer, calculate how much we invest in it that date, which is the total capital of that day divided by the 10 equally weighted stocks. And then we will basically figure out how much we can sell it for at the end of the next day. The sell price will be basically the adjusted close price at the end of the next date. And it's going to calculate how many shares you can buy each time by the amount that you can invest per stock divided by the actual price that you're buying for, which is the current day's adjusted close. So this all looks pretty good to me. And then after it does all these calculations where it buys and sells each day, it's going to update how much capital is in the portfolio and store the result for that date. And then here's where we're going to print the result. So I'm going to accept this and I'm going to run it. And I think this one will take probably quite some time. So I just finished running this code, and the results are about what I expected. So our final capital ended up being about $360,000 compared to the $100,000 we started with, which seems pretty good. If you invested $100,000 a year ago, you ended up with $360,000 now. You might be happy, but what you need to compare to is, what if you had invested in, let's just say, the Dow Jones Index and not the 10 biggest losers every day? That's one thing that we will have to go into comparing. One other thing I want to point out is this took me about 2 minutes to run. And because we're on the free account, we're actually using the weakest computer. So we're using the CPU-S. So if I hover down here, you can see change machine. So there are ways to get faster or more powerful machines going, but yes, I'm just using the free version right now. Also, you'll see a lot of red. That's fine. It's just a future warning. It's saying that this append function at some point will be aged out, and that's okay. Now let's jump to the next section and let's calculate the performance metrics, right? So if you've watched any of my other videos on portfolio performance, you'll know that one thing that is important is how much did your money grow? Like, how much did our capital change over time? But another thing that's important is how much risk was taken to achieve those returns. So if there's a more volatile investment, I will demand having a higher return to account for that. So we're going to calculate the annualized return, the annualized volatility, and then once we have these two values, then we calculate what's known as the Sharpe ratio, which basically adjusts the return for the risk that was taken. So the annualized return over the annualized volatility. We're going to assume that the risk-free rate is 0. But normally what you would do is you would go and look at what was like the 10-year treasury for that period of time and calculate that and use that. But that's fine. Let's dive into our prompt to have this run. So I'm going to go over here. The prompt I wrote for this is write Python code to calculate the following performance metrics based on the capital each day, annualized return, annualized volatility, and Sharpe ratio, assuming a risk-free rate of 0. Oh, I already put this twice. Okay, and then print the calculated metrics. So let's go ahead and see if the AI is up to this task. So first off, it assumes 252 trading days per year, which is great because it accounts for the weekends and the holidays, which are not trading days. Now it's going to compute the daily capital returns. So it's just finding the percentage change each day from the previous day. And then it's going to calculate the annualized return here, and then the annual volatility here. And then it's going to calculate our Sharpe ratio by taking the annual return over the annual volatility. Now, if we had not used 0 for the risk-free rate, it would have subtracted 0 in the numerator of this formula. But let's accept this and run. And one thing I also want to say is that a higher Sharpe ratio is preferable. So right now we have an annualized return of 16%, which to me is quite good. Annualized volatility of nearly 20%, and a Sharpe ratio of 0.8, which from my experiences, a Sharpe ratio of 0.8 is actually quite good. While my initial hunch is that a Sharpe ratio of 0.8 is pretty good, we didn't account for the risk-free rate, which would have made it lower. So what we really should do is compare the opportunity cost of what would we have invested in had we not invested in this strategy at the same time. What we could have invested in is we could have just bought the Dow Jones index or some ETF that proxies it and held that the entire time instead of doing this buy-sell strategy. And so if we can look at the Sharpe ratio of our original strategy with all the buy-sells every day, compare it to the Dow Jones index strategy, then we can see if this strategy really would have outperformed. So let's go down and grab our AI prompt to allow us to compare. So we're going to ask the AI to write Python code to fetch the daily adjusted close prices for the DIA ETF from Yahoo Finance for the same period as the Dow Jones data. And so this is just one of the largest indexes or ETFs that represent the Dow Jones index. We're going to calculate the daily returns for that ETF. Then we'll calculate the Sharpe ratio, again, assuming the risk-free rate is 0. And we will compare the Sharpe ratio of both strategies, so the mean reversion strategy to that of just holding this ETF. And then we'll have it print a message to say whether this strategy outperformed or underperformed based on the Sharpe ratios. So let's go ahead and give AI this task and see how it does. Okay, so this is where it's going to fetch the data from Yahoo Finance for that ETF. It's calculating the daily returns based on the adjusted close prices, same as how we did with the other strategy. Then it's calculating the annual return and the annual volatility. And then it's going to take the Sharpe ratio, again, as the annual return divided by the annual volatility. It's the same as what we did to calculate the Sharpe ratio up here. And then now here's where it's going to print the messages. So I'm going to accept this and run. And that actually ran quite quick. So the Sharpe ratio for just the Dow Jones Industrial Average was 0.74, which means that our mean reversion strategy slightly outperformed the general Dow Jones. So we got a 0.8 over here. This got a 0.74, so they're quite close with a slight outperformance to the mean reversion strategy. Now, one thing I would like to point out is that we assumed that there was no transaction cost to buy and sell, and we didn't account for the taxes of buying and selling. So if you had some Roth account that isn't taxed and you have like free transactions with your broker or something, then this Sharpe ratio would be quite accurate. But if not, you would have to actually lower the annualized returns for taxes and transactions. While I liked seeing the Sharpe ratios, 0.74 versus 0.8, I would be curious as to how did the actual DIA, so buying just this ETF, how did that strategy perform in terms of returns and variance compared to our mean reversion strategy? So we can have the AI tell us that. I'm going to say write Python code to print the mean reversion strategy's annual return, annual standard deviation, and Sharpe ratio side by side with the DIA. Nicely display which strategy had the higher risk-adjusted returns as measured by the Sharpe ratio. So let's go ahead and ask the AI to do that for us. Okay, so it's starting by gathering the data for both of these. It's creating a pandas data frame, and then it is going to print the performance. So we can see that the mean reversion strategy had a higher annual return of 16% compared to the buy and hold strategies, about 13%. The mean reversion strategy also was more risky though. It had about a 20% annual volatility versus the Dow Jones strategy only had a 17% volatility. But the annual return was higher by enough to make up for the higher risk and ended up with a higher Sharpe ratio of 0.8 versus about 0.74. Now, finally, I would like to visualize the growth of both of these portfolios. So I would like to see if we started with our $100,000 on day one 10 years ago, and then we just implemented these strategies, how much money would we have every day? And I want to see it in a beautiful line graph. So I'm going to ask AI to do just that for us with this here AI prompt. Write Python code to calculate the cumulative returns for both our mean reversion strategy and the DIA ETF. Multiply the cumulative returns by the investment or the initial investment of 100K to get the daily portfolio values for both strategies. So basically we're going to say, hey, if I started with 100K and then I lost 1%, the next day I'm at 99,000. But then the next day, let's say I made 2%. So now I'm at perhaps like 100,980 or something like that. And just keep track of those values every single day. Create a beautiful interactive plot using Plotly to visualize the growth for both strategies over time. And I'm telling it to include proper axis, labels, a title and legend, and display the plot. So the more that you tell it in details, I've found the better results that you sometimes get. So I'm going to copy that, go to Ask AI, put it in there, and let's run this thing. So it is importing the plot or the Python library that I told it to import. Now it's calculating the cumulative returns for both strategies, and then it's setting our initial amount at 100K, and it's going to track how the results grew over time. All right, there's all the code. I'm going to accept and run, and let's see how it does. There's our plot. And so, right, we start with 100K 10 years ago, and then we can see that the mean reversion strategy ended up outperforming. So we end up with that like 360K about at the end with the mean reversion strategy, whereas we only end up with the 286K with the strategy of just buying and holding the general Dow Jones. Now, one thing that I would like to clarify is that what happened in the past is not guaranteed to happen in the future. So we can take a look at all these historical returns and then say, hey, this strategy would have outperformed in the past, but that is not a sure thing to predict the future. And it's also possible that, let's say you tried all of this same code, and then let's say you tried it with the S&P 500 index instead of Dow Jones. Perhaps the mean reversion strategy wouldn't have worked in that case, but that's something that perhaps you can go on your own and maybe test out now that you've watched how I implemented this methodology here. And then also, I actually wrote an article for JetBrains that's currently on their website. So this is on their website. I have a series of articles in this Python for Finance area, and you can see I implemented a very similar methodology here that might be a little bit more professionally laid out than you saw in this video. So if you'd like to check out this article in more detail and the code here and the prompts here, then you can click on the link in the description to get redirected to this blog post as well. But anyways, thank you so much for watching, and if you stuck around for this whole video, I know it's a long one. I appreciate you guys, and have a great day. Thank you.